Okay. Think about the last time you thought about taxes. It was probably sometime in March or April, right? You sat down with your documents, you filed your return, you either wrote a check or you got a refund, and then taxes were done for the year. Here is what that version of taxes leaves out. The moment your paycheck hit your bank account this week, taxes were already gone. The last time you bought groceries, you paid a tax at the register. Your monthly rent check includes a tax your landlord passes to you, and almost nobody talks about it. The interest on your investments is taxed every single year, quietly reducing what compounds. And if you retire with a traditional 401k, the government taxes you again on money you already saved. Tax season in April is one event. But the tax system runs 365 days a year, and most people only see about 80 of those days. All right, let's start at the beginning. Your paycheck, say you earn $60,000 a year. That comes out to roughly $2,300 every 2 weeks before anything happens to it. That number is called your gross pay. The number that actually arrives in your bank account is your net pay. And the gap between those two numbers is where the tax system introduces itself. First hit, FICA, that stands for the Federal Insurance Contributions Act. It is not income tax. It is two separate taxes stacked together. Social Security takes 6.2% of your wages. Medicare takes 1.45%. Combined, that is 7.65%, gone before you see a dollar. And here's something most people do not know. Your employer matches every dollar of that. So every dollar you earn in wages is actually costing your employer 15.3 cents more per dollar than what shows up on your paycheck. The full labor cost of you is 15.3% higher than your gross salary. Second hit, federal income tax withholding. How much depends on your bracket, but for a $60,000 salary, expect around 12 to 14% of gross income going to federal withholding over the year. Third hit, state income tax, if your state has one. 41 states have a broad-based income tax. Rates vary from 1% to over 13% in California. For a middle-income worker in a typical state, figure 5%. Add it up. Before you see a dollar of your $60,000, you have already paid roughly 27 to 30% to taxes. The money arrives in your account already hollowed out, and it arrives that way every single time. And here is the part that will make you rethink tax refunds. 3 out of 4 Americans are over-withheld every year. The government takes more from your paycheck than you actually owe, holds it all year, pays you 0 interest, and returns it in April. The average refund in 2025 was over $2,900. People call that a win. But $2,900 held for 12 months, if it had been invested at 10%, would have earned $290. You gave the government a free loan for a year. The refund is not a bonus. It is your money coming home late. Okay, now you have your net pay, whatever survived withholding, and now you go spend it. Every time you buy something in most states, there is a sales tax waiting at the register. The national average combined state and local sales tax rate is 7.53%. Some states are higher, Louisiana at over 10% combined, Tennessee just over 9.5%. Some states have no sales tax at all, Oregon, Montana, New Hampshire, Delaware. But even in a state with no sales tax, you are not out of the woods, because some taxes are embedded inside prices before you reach the register. Every gallon of gasoline in America carries a federal excise tax of 18.4 cents, plus state taxes on top. California's total gas tax is over 70 cents per gallon. Illinois, over 66 cents. The price on the pump already includes the tax. You never see it as a line item. Alcohol and tobacco carry excise taxes. Your airline ticket carries a 7.5% federal tax plus airport-specific fees. Your phone bill carries federal and state taxes on top of the plan cost. A fully loaded phone bill for a typical American might include 4 to 6 separate taxes and fees on a single monthly statement. Check this out. For a household earning $30,000 a year, spending roughly 80% of income on taxable goods, the sales and excise tax burden approaches 6% of total income. For a household earning $300,000, spending a smaller share on taxable goods, that burden might be 2 or 3% of income. The less you make, the harder the spending taxes hit. That pattern is called regressivity, and it runs through most of the taxes that exist below the income level. All right, most Americans rent their home, and renters almost universally do not know they are paying property taxes. Property taxes are paid by property owners, technically. Landlords write the check to the county, but economists have studied for decades how much of that cost gets passed through to tenants, and the answer is almost all of it. MIT Center for Real Estate found that 80 to 90% of property tax changes get reflected in rent within a few years. If a landlord's property tax bill increases by $1,000 a year, rent goes up by $800 to $900 a year to compensate. So if you are paying $1,800 a month in rent, a portion of that, likely $250 to $350, is flowing directly to the property tax bill of the building you live in. That is about $200 to $350 a month, or $3,000 to $4,000 a year, going to fund local government, roads, and schools. Your local schools probably through your landlord's bill. Yeah, here's the wrinkle. Homeowners can deduct property taxes from their federal taxable income up to a $10,000 annual cap. Renters cannot. You pay property taxes indirectly and get zero deduction for it. A homeowner next door paying the same $3,000 in property taxes gets a deduction. You get nothing except the slightly lower school funding complaint when the levy fails. Okay. You put money into a taxable brokerage account. The market returns 10% a year on average over long periods. You read the compound interest formula, money times the rate raised to the number of years. You run the numbers and it looks beautiful. $100,000 at 10% for 30 years becomes $1,745,000. That calculation is the version without taxes. The real number depends on what you pay in taxes along the way. In a taxable account, you pay taxes on dividends each year as they arrive. You pay capital gains taxes when you sell at a profit. If you hold for more than a year, you pay long-term capital gains, 0 to 20% depending on income, plus a 3.8% net investment income tax if your income exceeds a certain threshold. If you hold for less than a year, you pay ordinary income rates, which can run up to 37%. This annual tax drag, the return lost to taxes each year, typically amounts to roughly 1.5% to 2% of portfolio value per year for a taxable investor. Take that $100,000 at 10%, reduce the effective return to 8% after tax drag. Over 30 years, it grows to approximately $1,060,000 instead of $1,745,000. That difference is $685,000. All right. That gap, nearly $700,000 on a single $100,000 investment over 30 years, is not a math trick. It is the actual cost of operating in a taxable account versus a tax-advantaged one. It is why the conversation about Roth accounts, traditional 401ks, and tax-advantaged buckets is not a detail. It is foundational. The tax-advantaged retirement account is not a tax loophole. It is the answer to the compound interest formula that actually includes taxes in the math. Let's jump forward. You have worked for 40 years. You have paid FICA on every paycheck. You have saved in your traditional 401k. You retire. Traditional 401k withdrawals are taxed as ordinary income. Every dollar you pull from that account is counted as regular income and taxed at your current bracket. If you are withdrawing $40,000 a year from your 401k and also receiving Social Security, those two income streams push you into a bracket where a meaningful portion of your income is taxed. Now, Social Security. You paid into Social Security through FICA for your entire career. 6.2% of every dollar earned year after year after year. In retirement, if your combined income, that is adjusted gross income plus half your Social Security benefit, exceeds $25,000 for a single filer or $32,000 for a married couple, up to 50% of your Social Security benefit becomes taxable. Push past $34,000 single or $44,000 married, and up to 85% becomes taxable. That's crazy, right? The government collected FICA taxes from your paycheck for 40 years to fund Social Security. You retire, and then the government taxes the benefit you funded with those taxes. There is one more layer at retirement: Medicare premiums. Standard Medicare Part B in 2025 is about $175 a month. But if your income from retirement accounts and Social Security exceeds $106,000 for a single filer, you pay more. That extra charge is called IRMAA, the income-related monthly adjustment amount. At higher incomes, extra Medicare costs can exceed $500 extra a month per person. The tax system keeps following you. Okay, the last layer: what you leave behind. Federal estate taxes apply to estates above $13.99 million per person as of 2025, which is $27.98 million for married couples. The rate is 40% on the amount above that threshold. The One Big Beautiful Bill Act raised that to $15 million per person permanently starting in 2026. Fewer than 0.2% of estates are large enough to pay federal estate tax. For most people, this one is not the concern. The concern is inherited retirement accounts. All right. If your parents leave you a traditional IRA or a traditional 401k, you inherited money that has never been taxed. The government wants that tax. Before 2020, you could spread distributions from an inherited IRA over your entire lifetime, a strategy called the Stretch IRA. The Secure Act of 2019 eliminated that. Now, most non-spouse beneficiaries must empty the inherited IRA within 10 years. If you inherit $500,000 in a traditional IRA in your peak earning years, say your 40s, you must pull $50,000 per year for 10 years. On top of your normal income, that pushes you into higher brackets for a full decade. That $500,000 in pre-tax money might net you $350,000 or less after taxes, depending on your income level. The system has one final mechanism: stepped up basis. When you inherit a stock or a piece of real estate, not a retirement account, its cost basis resets to the current market value at the time of inheritance. If your parent bought Apple stock for $10,000 30 years ago and it is now worth $800,000, you inherit it at $800,000 basis. Zero capital gains tax on the $790,000 of appreciation that occurred during their lifetime. This is the single largest tax benefit available for inherited wealth. It eliminates capital gains on a lifetime of investment growth, but only for those who hold the assets until death. All right, let's step back and look at the whole thing at once. The average American will pay an estimated $524,625 in combined taxes over a lifetime. That is about 34.7% of estimated lifetime earnings. Tax Freedom Day in 2025 fell on April 16th. That is the day when, if you had been working every day of the year, you would have finally paid off your total combined tax burden and started keeping money. Day 99. That is not good or bad by itself. Roads get built, schools get funded, Social Security arrives in retirement accounts, Medicare pays for hospital care, the taxes go somewhere. But here's what this video was actually about. Almost none of that picture is visible from where most people stand. The withholding system, built in 1943, removes the money before you see it. The sales tax is a small number on a receipt that disappears into the total. The property tax inside your rent has no line item. The capital gains drag never shows on your portfolio statement as a tax line. The Social Security taxation rule appears in the fine print of your retirement math. Each piece arrives separately and each one seems manageable on its own, but the combined total is the biggest financial force operating on your life. Once you can see all 5 layers, the paycheck tax, the spending tax, the housing tax, the investing tax, and the legacy tax, you can actually make decisions. You can adjust your withholding to stop giving the IRS a free loan. You can prioritize tax-advantaged accounts where compounding runs without the annual tax drag. You can structure an inheritance in a way that accounts for the Secure Act. You can compare Roth versus traditional with the real numbers. None of that is possible without the map. And now you have it. If this is the kind of thinking you want to see every week, subscribe. We go this deep on money every time.